Hello, good morning. I am Amnish Jain. Welcome to the monthly debt outlook from Canara Bank. This month news flow has been dominated by the US tariff situation. President Trump continues to befuddle markets while going back and forth on tariffs. He has already backtracked on number of hard tariffs that he was proposing to put on countries in terms of reciprocal tariffs with all countries. Now the proposal has been diluted, saying that certain countries will be targeted and they will look at more non-tariff barriers. Markets, as expected, were volatile. But US markets, especially US rate markets, continue to remain in a range-bound manner. 10-year US yield broadly ranged between 420 to 440. And we did not, obviously, equity markets, we did see a lot of volatility as various news flows hit the market in the last 1 month, especially on tariffs. US has already put tariffs of 25% on autos imports into US, which will likely impact countries like Mexico, Canada, China, and to a certain extent India, who export auto components to the US. The other Asian countries will also be impacted, especially Japan. Japan is a big exporter of cars and auto components to the US. The other geopolitical situation, US has worked hard and fast to see that the Ukraine-Russia war comes to end as soon as possible. To that extent, they started negotiating directly with Vladimir Putin without engaging with Ukraine or any of the European partners. To that extent, now Ukraine is agreeable to a ceasefire if Russia comes on the table. Russia had, to a certain extent, has been demanding a lot from the US, and lately US President has indicated his discomfort with the Russian position. To that extent, some news flow shows that Russia is engaging to come to the negotiating table with Ukraine. It may involve ceding some territory of Ukraine to Russia and security guarantees from the US and the EU bloc for Ukraine. These things will unfold in the coming weeks because President Trump has been very impatient on things not moving in the right direction. The Israel-Hamas war, which had gone into ceasefire for last 2-3 months, again began when Israel started bombing Gaza territory. Again, that situation where US is supporting Israel and not Palestine, the situation remains worrisome on the ground. To that extent, oil prices went up slightly, but they still remain in comfortable range, around $70 to $80 a barrel. Coming to India, situation remains, in terms of macroeconomic parameters, remains good. Inflation fell to 3.6% in February, lowest in the last probably 6 to 8 months. When we saw 6.5% in October, when because of food prices, the inflation shot up. Since then, food prices have moderated considerably, and we saw inflation come at 3.6% in February. RBI had already cut rate in anticipation of a lower inflation. In terms of growth numbers, we are seeing growth moderating to about 6.2% to 6.3%. Coming to FY26, growth is expected to be about 6.3 to 6.8% as per government estimates. RBI estimates are on the higher side. We'll get a fresh estimate from RBI in the upcoming monetary policy on 9th of April. With the growth and inflation both moderating, the time is ripe for again a rate cut. RBI had already delivered a rate cut in February and followed up with measures to ensure that liquidity, which had turned quite negative in the last few months of 2024 and early 25, and put it into a positive durable liquidity situation. To that extent, they conducted open market operation purchases of almost 2.5 lakh crores in February and March. Also, they did USD INR sell swaps where RBI buys USD and sells INR to the market to the extent of almost $20 billion. That injected almost 3.5 4 lakh crore liquidity into the system. Market liquidity is still not positive, and despite RBI efforts, RBI is likely to continue with more tools to look that market liquidity and or the durable liquidity in the system turns positive, because that is essential for transmission of lower rates into the economy. Banks have been complaining about not able to lend because of deficit of liquidity, and with economic growth slowing down, it is up to RBI to ensure there is sufficient liquidity in the system for onward lending from the credit side. We expect RBI to continue with open market operations in coming months, apart from the rate cut which is expected on April 9th. RBI may also shift the policy stance from neutral to accommodative. They chose not to change stance in February, citing global tariff problems and no uncertainty on tariffs. And things will become more clearer, and the whole package of tariff is announced by the US administration on April 2nd. And RBI will have more data to work with and determine to change stance, probably to change stance from neutral to accommodative. In terms of Indian rates, we saw a good rally in rates, where rates fell from about 675 levels to about 658 levels in March end. This was supported by demand side from long investors. There was also FI flows which came in before the Fed policy in March. US Fed policy in March did not change rates and did not show too much concern on the tariff situation. So markets were somewhat happy about that. To that extent, market yields fell, and Indian market especially fell more because of continued open market operations being done by RBI, where they were doing 50,000 crores of open market purchases every week. That kept yields down, and we anticipate that going into the policy, market yields should go down further to around 6.5%. Inflation going forward is likely to be lower, around 4%, if not lower, and that should give some comfort to RBI or continuing to cut rates probably in the next few policies. The market is pricing about 50 basis rate cut in the 1 year OIS market. So after this rate cut, there is at least an expectation of one more rate cut in the remainder of the year. More participants are expecting anywhere between 75 to 100 basis full rate cut cycle. So we could expect 2 to 3 more rate cuts in this year. This is likely to lead the yield curve lower. Corporate bond market also has moved in tandem with the yield curve. We saw corporate market yields also fall, especially on the short end, where because of liquidity tightness, the yields were higher. But those corrected faster now as RBI continued with the liquidity measures. In April, typically liquidity tends to be positive, as discussed, because government upfronts the expenditure for the year. And RBI also will look at ways of ensuring liquidity remains positive for transmission of rate cuts through the banking channel. From the fund perspective, we expect short end curve to perform after long end has already been performing for some time. We expect 1 year yields to fall more than the longer term yields. This should be helpful for funds like low duration fund and ultra short term fund, as a majority of their investments are in 6 months to 18 months bucket. As usual, investors should look at their risk return profile and their investment horizon while investing in debt products. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.